Hi, I'm David Smith from Silicon Valley Business School, where we provide affordable, real-world business education to everyone, everywhere, and we mentor and educate entrepreneurs, helping guide their startups towards success through our Mentor Accelerator program online. Today, I'm going to talk to you about how to structure the shares for founders and for employees and other members of the team in a Silicon Valley style startup company. All right, so in a previous video, you'll have seen that when you form your company, you need to form a Delaware Corporation. You need to form it with typically the Silicon Valley style is 20 million shares of common stock. If you want to raise funding from investors, venture capital investors anywhere in the US or typically anywhere in the world, they're going to want you to form a Delaware Corporation. They're going to want to see it set up in the cookie cutter style that they're familiar with. And so and I'm going to show you here how it works in terms of how the shares are structured. So you set up 20 million shares of common stock. You set a par value on those shares of a hundredth of a cent each, typically. Then you will issue 10 million shares to the founders, 3 million to an equity incentive plan, and then there'll be 7 million left to issue to investors. At some point, you might need more than that, and you can go back and you can authorize more shares from the state of Delaware at that point. But this is the typical style of cap table that you will need to get started. Okay, now if there are no co-founders, there's just one founder. I formed a company like this myself. I was the one founder. I gave myself all 10 million of these founders' shares, and I had them fully vested. There's no reason for me not to have those vested when I grant them to myself. So that's a very simple structure. Basically, it involved me buying these 10 million shares for 1/100th of a cent each, is $1,000. So, and that's a very simple transaction to set up. All right, so then let's look at the situation if there are two co-founders. If there are two co-founders, you might want to split the shares equally, so 5 million each, and have them fully vested. The issue here is that if you form this business with the co-founder, and I've actually had this experience as well, and then the co-founder leaves, then the co-founder still has 5 million shares and you have 5 million shares. So the idea is to have vesting, because it makes it more fair on everyone. If someone leaves the company after 6 months or a year, then they have to sell some of their shares back at this price, is essentially the way the vesting stock purchase agreements work. So this type of arrangement where you give each other fully vested shares up front is slightly unhealthy in the situation where one of the founders leaves, because the other one then is doing all the work and is doing substantially more work than the founder that's left. So that's where we incorporate vesting. Now, typically vesting is over 4 years. So you may have a situation where the founders come in, that each one is provided with 5 million shares, or two founders, and then you have vesting monthly over 4 years, which would be 104,167 shares vesting each month. So after month one, if founder 2 leaves after month 1, founder 2 will still own 104,167 shares, but will have to sell all the rest back to the company at this price. Now, one thing about once you introduce vesting, then it's really important that you make this 83B election. This is an election at the IRS. You can see the website here. Basically, it saves you substantial amount of money in taxes later on. So you need to make this, provide your social security number. This has to be done within 30 days. If you don't do this, then when you come to sell your shares, you'll be paying 2-3 times as much tax as you would necessarily have to. So make the 83B election if you have vesting on the shares. Now, having many startups, there's a lot of work that's gone in before the company was actually formed and before the shares were issued. So you might have some of the shares vested on issue, and this is typically a realistic situation where you would say the two founders, a quarter of their shares are vested on issue, and then the remainder vest over a period of 4 years. So at 78,125 shares per year. Now, so this is a typical situation where you have two equal founders. If there are 4 equal founders, it looks like this, with 25% vested on issue, and the rest of them 39,000 vesting per year. Each founder gets 2.5 million shares. If you have 6 founders, then it would look like this. 10 million shares, 1.666 million for each founder, 420,000 shares vested on issue, 26,042 shares vesting each month for 4 years. And typically you have the vesting set at the last calendar day of the month. But all the founders may not be equal. So you may have a situation like this one where you have one founder that deserves more. She gets 3 million shares. The other 2 founders get 2 million shares, and other three of the founders get 1 million shares. And again, you have the vesting process with some of them vesting on issue and some of them vesting over 4 years. So that you can play with these numbers and figure out how to distribute the shares to the founders of your company. Obviously, it's important that you want to keep everybody happy. If these founders are contributing and they're important to the business and they've played an important part in building the business to this point, then you want to reward them and keep them sweet. So this is essentially how you do it. All right, so let's now look at the equity incentive plan. Typically, after the founders have been issued their 10 million shares, you will form an equity incentive plan. Actually, venture capital investors require this from startup companies, usually. So you would allocate something like 3 million shares to an equity incentive plan. It says 20 million. Yes, 3 million is about right. Sometimes they ask for a minimum of 15% in an equity incentive plan, or even 20%. So it might be 3 to 4 million shares in an equity incentive plan. And this is a plan that's approved by the shareholders, and then the board of directors is given discretion to actually grant and issue these shares. Now, these shares are distributed to incoming staff that come into the company after the founders. And this is a typical situation. An executive vice president might have 300,000 shares. Typically, these guys don't have anything vested on issue. They're coming into the company after it was formed. They don't have any of their shares vested upon issue, and it vests monthly over 4 years. So let's say the executive vice president might have 300,000 shares vesting at a rate of 6,250 per year over 4 years. Say there were 2 of those, and that uses up 600,000. So you can see how this works. We're using our 3 million shares here to hire 42 people. Now, once you've hired 42 people and you've used up all those, the equity incentive plan, you can go back to the shareholders and the shareholders may need to go back into the state of Delaware and authorize more shares, but you can get another equity incentive plan for additional employees as they come in. So that's it. That's the way that Silicon Valley companies are structured. Delaware C corporations, this is how the shares are allocated, And obviously there's some discretion as to they can be customized for different situations depending on how many founders there are and so on. But this is essentially how it works. If you want any more information on this, you can come visit us at Silicon Valley Business School. We have a whole knowledge base of information. We have 25 courses. We have a knowledge base that's driven by milestones, so you can see a lot of more detail about, actually we have the forms for the equity incentive plan and all that type of stuff. So come visit us at Silicon Valley Business School. All right, thanks very much.